U.S. government issues emergency order. J.P. Morgan. Told to short silver behind closed doors. A directive was issued, not a suggestion, an order. One of America's most powerful banks. Instructed to take a position that could cost them billions. But here's what they're not telling you. This wasn't about profit. It was about control. Silver just became more than a commodity. It became a threat. And when governments treat markets like battlefields, someone always loses. The question is, who? Welcome to John Analyst. If you've lived long enough to see markets rise and fall, to watch currencies lose their meaning, and to witness the quiet hand of power reshape the rules, then you already know something most people refuse to see. The game isn't fair. It never was. But understanding it, that's where wisdom lives. So if you value clarity over noise, strategy over panic, do something simple. Subscribe to this channel. Not because I ask, but because the next time something like this happens, you'll want to know before everyone else does. And one more thing. I'm curious, where are you watching this from right now? Drop your location in the comments. Let's see how far this message travels. On a day that seemed like any other in the financial world, something unusual happened. A message went out. Not through public channels, not through press releases, but through the kind of corridors where decisions are made before the world ever hears about them. J.P. Morgan, one of the largest and most powerful banks in the United States, received what insiders would later describe as an emergency directive. The instruction was clear: short silver. Now, for those unfamiliar with the term, shorting means betting that the price will go down. It means taking a position that profits when an asset loses value. And in this case, the asset was silver. But here's where the story becomes more than just another Wall Street transaction. This wasn't a voluntary trade. This was an order. And when a government issues an order to a private institution in a supposedly free market, it raises a question that cannot be ignored. What emergency could possibly justify such an action? To understand why this matters, one must first understand what silver represents in the modern economy. Silver is not just a precious metal. It is not just something collectors keep in vaults or investors buy during uncertain times. Silver is embedded in the infrastructure of modern civilization. It conducts electricity better than almost any other material. It is used in solar panels, medical devices, electronics, and military hardware. Every smartphone, every computer, every advanced piece of technology relies on silver in some form. And unlike gold, which sits in vaults and changes hands without being consumed, silver gets used up. It disappears into products that are manufactured, sold, and eventually discarded. This creates a fundamental problem. Demand keeps rising. Supply is not keeping pace. And when demand exceeds supply in any market, the natural result is higher prices. But in this case, higher prices are not just an economic inconvenience. They represent a strategic vulnerability. Governments around the world have quietly begun treating silver differently. In recent years, the United States officially reclassified silver as a critical mineral. Not a luxury, not a speculative asset, a critical mineral. That designation carries weight. It means silver is now viewed the same way as lithium, cobalt, and rare earth elements. It means the government believes the nation's security and economic stability depend on access to this material. And when something becomes critical, the rules change. Markets that were once driven by supply and demand suddenly become subject to intervention. Prices that were once determined by buyers and sellers can be influenced by policies designed to protect national interests. So when J.P. Morgan was told to short silver, it was not because the bank wanted to make a profit. It was because someone, somewhere, decided that the price of silver was moving in a direction that could not be allowed to continue. But why would a rising silver price be considered dangerous? The answer lies in what a rising price reveals. When silver climbs too high, too fast, it sends a signal. It tells the world that physical supply is tight. It tells manufacturers that input costs are about to surge. It tells other nations that the United States may not have as much control over critical resources as it claims. And perhaps most importantly, it tells the public that something is wrong. Because when people see the price of a strategic metal skyrocket, they begin to ask questions. They begin to wonder if the financial system is as stable as they've been told. They begin to move their money into physical assets instead of paper promises. And that shift in behavior, that loss of confidence, is the kind of thing that keeps central planners awake at night. So the order was given. J.P. Morgan, whether willingly or reluctantly, took the position. The short was placed. And for a moment, the price stabilized. But here's the problem with trying to control a market by force. It only works if the fundamentals cooperate. And in the case of silver, the fundamentals were not cooperating. Industrial demand was rising. Physical inventories were falling. And around the world, other players were watching. They saw the suppression. They recognized the opportunity. And they began to buy. What J.P. Morgan and the authorities behind this directive may not have fully anticipated was the reaction from the physical market. Because while paper contracts can be created with the stroke of a keyboard, Physical silver cannot. And when buyers demand delivery, when they refuse to settle for cash, when they insist on holding the actual metal, the game changes. This is not the first time a government has intervened in a commodity market. History is filled with examples. The London Gold Pool in the 1960s tried to suppress gold prices. It failed. The Hunt brothers tried to corner the silver market in the 1980s. They were crushed by regulatory intervention. In both cases, the lesson was the same. Markets can be manipulated for a time, but they cannot be controlled forever. And so the question remains, how long can this emergency order hold the line? How long before the physical market overwhelms the paper market? And when that moment comes, what happens next? There is a list. Most people have never seen it. Most people don't even know it exists. But every major government in the world maintains one. It's called the Critical Minerals List. And recently, silver was added to it. This wasn't announced with fanfare. There were no headlines, no press conferences. Just a quiet update to a government document that most citizens will never read. But for those who understand what that list represents, the implications were immediate. Because once a material appears on that list, it stops being treated like a commodity. It becomes something else entirely. It becomes a matter of national security. To understand why this matters, one must first understand what the term critical mineral actually means. In the language of government policy, a critical mineral is defined as a non-fuel mineral or mineral material that serves an essential function in one or more sectors. But that definition is deliberately vague. What it really means is this. A critical mineral is something the nation cannot function without. Something that, if suddenly unavailable, would cripple industries, compromise defense systems, or destabilize the economy. And once that designation is made, an entirely different set of rules comes into play. Governments don't just watch critical minerals. They manage them, they control who gets access, they decide where supply goes, they influence pricing through subsidies, tariffs, and strategic stockpiles. And in extreme cases, they restrict exports to keep the material inside their own borders. This is not theory. This is already happening. China, which produces the majority of the world's rare earth elements, has repeatedly used export restrictions as a geopolitical weapon. When tensions rise with another nation, supply gets cut. When cooperation is needed, supply flows again. The message is clear. Control the resource, control the negotiation. Silver's addition to the critical minerals list was not arbitrary. It was a recognition of reality. The United States military relies on silver for guidance systems, communications, equipment, and radar technology. The push toward renewable energy has created massive demand for silver in solar panels. Every electric vehicle requires significantly more silver than a traditional car. Medical imaging, water purification, and antibacterial applications all depend on silver's unique properties. In short, modern civilization runs on silver. And the people making decisions at the highest levels of government understand that. But here's where the story takes a darker turn. Because while silver has been classified as critical, the United States does not produce nearly enough to meet its own needs. Domestic mining operations have been declining for decades. Environmental regulations, permitting delays, and lack of investment have all contributed to a supply deficit. Today, the United States imports the majority of the silver it consumes, and that creates a vulnerability. When a nation depends on foreign supply for a critical resource, it faces two options. Option one is to secure that supply through trade agreements, alliances, and long-term contracts. Option two is to ensure that the price remains low enough that competitors cannot weaponize scarcity. The emergency directive to JP Morgan suggests that option two is currently in play. Because here's the uncomfortable truth that most analysts refuse to say out loud. If silver's price rises too quickly, it doesn't just hurt manufacturers, it sends a signal to every other nation watching. It tells them that the United States is struggling to secure supply. It tells them that leverage exists. And in a world where economic competition has replaced traditional warfare, leverage is everything. Consider what happened with other critical materials in recent years. When lithium prices surged, nations scrambled to secure battery supply chains for electric vehicles. When rare earth prices spiked, countries realized how dependent they were on Chinese production. When semiconductor shortages hit, entire industries ground to a halt. Each time, the lesson was the same. Dependency on critical materials is a national security risk, and price volatility exposes that risk for everyone to see. So when silver began pushing toward price levels that would attract global attention, a decision was made. The price had to be managed, not through market forces, through intervention. And that intervention took the form of an emergency directive to one of the most systemically important banks in the country. But there's another layer to this story that makes it even more complex. Silver doesn't just exist in physical form, it also exists on paper. Futures contracts, options, exchange-traded funds, and derivatives all claim to represent silver. But they don't actually require physical metal to change hands. Most of these instruments are settled in cash, Buyers received dollars, not silver. And for years, that system worked. People were content to trade paper claims without ever demanding the actual metal. But something has changed. In recent months, an unusual pattern has emerged. Delivery requests have been rising, not from speculators looking to flip contracts, from entities that actually want the physical metal. Industrial buyers, foreign governments, strategic investors who no longer trust paper promises. When delivery requests rise in a market dominated by paper contracts, it creates a problem, because the system is built on the assumption that most people will never ask for delivery. The entire structure relies on leverage, on the idea that 1 ounce of physical silver can support multiple claims of ownership. But when people start demanding the actual metal, that leverage becomes a liability. And this is where the critical mineral designation intersects with market mechanics in a dangerous way. If silver is truly critical, then governments have an incentive to ensure stable, affordable supply. But if the paper market is over-leveraged, then any surge in delivery demand could expose a shortage. And a shortage in a critical mineral is not just a market problem. It's a national security crisis. So the question becomes, was the emergency directive to JP Morgan an attempt to suppress price, or was it an attempt to buy time? Time to secure more physical supply, time to reduce dependency on foreign production, time to prevent a delivery crisis that could reveal just how fragile the system really is. The answer may not matter, because regardless of intent, the outcome is the same. A market that was supposed to be free is now being managed. And when markets are managed, they stop reflecting reality. They start reflecting policy. But policy cannot change physics. And the physical reality is this: silver is being consumed faster than it's being mined. Stockpiles are shrinking. And the gap between paper claims and physical metal is widening. What happens when that gap becomes too large to ignore? What happens when the people holding paper demand their metal? And what happens when there isn't enough to go around? There's a difference between owning something and owning the promise of something. Most people don't realize this until it's too late. They see a number on a screen. They believe that number represents reality, but numbers can be printed. Reality cannot. In the silver market, this distinction has become the fault line that could fracture the entire system. On one side, there is physical silver. Metal you can hold. Metal you can store. Metal that exists in the real world and obeys the laws of physics. On the other side, there's paper silver, contracts that promise delivery, shares in funds that claim to hold metal, derivatives that derive their value from the underlying commodity. For decades, these two markets existed in relative harmony. The paper market provided liquidity. The physical market provided legitimacy. And most participants were content to trade the paper without ever touching the metal. But that balance is breaking down. It started quietly. A refinery in Switzerland reported longer than usual wait times for fabrication. A dealer in Singapore mentioned that premiums for physical bars were rising above spot price. An industrial manufacturer in Germany complained that securing silver for production was taking weeks instead of days. These were small signals, isolated incidents, easy to dismiss. But then the pattern became harder to ignore. Delivery requests at major exchanges began to climb, not from retail investors, from entities that don't typically stand for delivery, foreign governments, defense contractors, technology manufacturers who suddenly couldn't afford delays in their supply chains. And here's what made this pattern unusual. Deliveries were being requested outside of traditional delivery months. In the futures market, most contracts are settled in specific months when the exchange facilitates physical transfer. But when deliveries start happening in off months, it signals something different. It signals urgency. It signals that someone needs the metal now, not when it's convenient for the exchange. At the same time, another indicator began flashing red: lease rates. For those unfamiliar with the term, lease rates represent the cost of borrowing physical metal. When lease rates are low, it means metal is abundant and easy to access. When lease rates spike, it means metal is scarce and lenders are demanding a premium for parting with it. In recent months, silver lease rates have been behaving erratically: sudden spikes, unexplained volatility, the kind of movement that suggests someone, somewhere, is scrambling to find metal. But perhaps the most revealing signal came from a phenomenon that most casual observers don't even know exists: backwardation. In a normal commodity market, future prices are higher than spot prices. This makes sense. Storing metal costs money. Ensuring it costs money. Time has value. So buyers are willing to pay more for a promise of delivery 6 months from now than for immediate delivery today. But when backwardation occurs, that relationship flips. The spot price becomes higher than the future price. Buyers are willing to pay more for immediate delivery than for a promise of future delivery. And that sends a very specific message. Trust is eroding. People want the metal in their hands, not a contract that promises it later. Backwardation doesn't happen often. When it does, it's usually brief. A temporary disruption, a logistical hiccup. But in silver, backwardation has been appearing with increasing frequency. Not for hours, for days, sometimes weeks. This is not normal market behavior. This is the market screaming that something is wrong. Now, combine these signals: rising delivery requests, spiking lease rates, persistent backwardation, and ask yourself a simple question: what do these things have in common? They all point to the same conclusion. Physical silver is becoming harder to find. But how is that possible in a market that trades millions of ounces every day? The answer lies in understanding where that silver actually exists. The vast majority of silver traded on exchanges is not physical metal changing hands. It's contracts. Contracts that reference metal held in vaults. But those vaults don't hold enough metal to satisfy every contract if everyone demanded delivery at once. The system relies on the assumption that most people won't ask. And for years, that assumption held true. Speculators traded contracts for profit, not for metal. Investors held ETFs without questioning whether the metal was really there. Industrial buyers secured supply through long-term arrangements that didn't stress the spot market. But something shifted. Maybe it was the critical mineral designation that made people nervous. Maybe it was geopolitical tensions that made nations want to control their own supply. Maybe it was inflation fears that drove investors toward hard assets. Or maybe it was something simpler. People started doing the math. Global silver production sits at roughly 850 million ounces per year. Industrial demand alone consumes more than half of that. Jewelry, coins, and investment demand take another significant portion. What's left for inventories and strategic reserves is shrinking every year. And here's the part that makes this particularly dangerous. Unlike gold, which mostly sits in vaults and gets recycled efficiently, silver gets consumed. It goes into electronics that are eventually thrown away. It goes into solar panels that are installed on rooftops for decades. It goes into medical applications, where it's used once and discarded. A significant portion of silver produced each year is effectively lost to the market. This creates a structural deficit. More silver is being used than is being mined. For now, that deficit is being filled by drawing down above-ground stockpiles. But stockpiles are finite, and when they run low, the only way to balance supply and demand is through price. Except price isn't being allowed to balance supply and demand. That's what the emergency directive to JP Morgan was designed to prevent. By flooding the paper market with short positions, the price could be suppressed. And as long as the price stayed suppressed, the public wouldn't panic. Industrial buyers wouldn't hoard. Foreign governments wouldn't rush to secure supply. But suppressing price doesn't create supply. It only delays the inevitable. And while the paper market was being managed, the physical market was quietly tightening. Premiums in Asia began to diverge from Western spot prices. Dealers reported longer wait times for large orders. Refineries were operating at capacity, but still couldn't keep up with demand. This is the squeeze. Not a dramatic, sudden event, but a slow, grinding pressure that builds over time. A pressure that can be ignored for months, maybe even years, but it cannot be ignored forever, because eventually someone will demand delivery and be told to wait, or worse, be told that delivery isn't possible. And when that happens, the trust that holds the entire system together will shatter. The paper market will be exposed as over-leveraged. The physical market will be exposed as undersupplied. The price, which was suppressed for so long, will be forced to reflect reality, not gradually, violently. The only question is when, and whether those in positions of power can secure enough physical supply before that moment arrives, or whether they're simply buying time that's running out. Every system has a breaking point, a moment when the weight it's been carrying becomes too much, when the mechanisms designed to maintain stability begin to crack under pressure. And when that moment arrives, it doesn't announce itself with warnings. It simply happens. The silver market is approaching that moment, not because of speculation, not because of manipulation, but because the gap between what the system claims to have and what it actually has is widening beyond repair. To understand why this matters beyond the precious metals community, one must understand how modern financial markets are interconnected. They don't exist in isolation. They're linked through counterparty relationships, derivative contracts, margin requirements, and clearing systems. When one market experiences stress, that stress doesn't stay contained. It spreads. Consider what happens when the price of silver moves suddenly, not a gradual climb, a spike. The kind of move that happens when suppression fails and market forces take over. First, the institutions holding short positions face immediate losses. Those losses trigger margin calls. Margin calls force those institutions to either post more collateral or close their positions. But closing a short position means buying. And buying in a rising market accelerates the price movement. This creates a feedback loop. Rising prices force more buying. More buying drives prices higher. Higher prices trigger more margin calls. For a single institution, this is painful. For a systemically important bank like JP Morgan, this is dangerous. Because JP Morgan doesn't just trade silver. It provides clearing services, holds derivatives, manages counterparty risk, and serves as a critical node in the global financial infrastructure. If JP Morgan experiences significant stress, that stress radiates outward. Other banks that have exposure to JP Morgan suddenly reassess their risk. Credit default swaps, which insure against counterparty failure, begin to price in higher risk. Liquidity in related markets starts to dry up as participants become cautious. And before long, what started as a problem in the silver market becomes a problem in the financial system. This is not hypothetical. History has shown repeatedly that seemingly isolated market events can trigger systemic crises. The collapse of long-term capital management in 1998 started with bad bets on Russian bonds, but it nearly brought down the entire financial system because of how interconnected the firm was. The 2008 financial crisis started with subprime mortgages, but it spread globally because of derivative exposure and counterparty relationships. Silver may seem like a small market compared to stocks, bonds, or currencies, but size isn't what determines systemic importance. Interconnection is, and silver is deeply interconnected, not just through financial contracts, through the physical economy. When the price of silver rises sharply, manufacturers face a choice. They can absorb the cost, which destroys their profit margins. They can pass the cost to consumers, which contributes to inflation. Or they can reduce production, which creates supply shortages in downstream industries. Consider the electronics sector. Every smartphone, laptop, and tablet requires silver. If silver prices double or triple, the cost of producing these devices increases significantly. Companies like Apple, Samsung, and Intel suddenly face input cost pressures they can't easily manage. They can't simply switch to a different material because silver's properties are unique. So they either pay the higher price or they slow production. The same logic applies to solar panel manufacturers. Silver is essential for photovoltaic cells. As governments push for renewable energy transitions, demand for solar panels is surging. But if silver becomes too expensive, the economics of solar energy change, projects get delayed, targets get missed, and the entire green energy transition, which depends on affordable inputs, faces a bottleneck. Medical device manufacturers face similar constraints. Silver's antibacterial properties make it irreplaceable in certain applications. Wound dressings, surgical instruments, and diagnostic equipment all rely on silver. If prices spike, healthcare costs rise, not because of policy changes, because of input costs that can't be avoided. This is why silver's classification as a critical mineral matters so much. The government isn't just concerned about investment markets. It's concerned about the real economy, about whether industries can function, about whether supply chains remain stable, about whether inflation stays controlled. And this is where the emergency directive to JP Morgan takes on a different dimension. It wasn't just about protecting a bank. It was about protecting the broader system from a price shock that could cascade through multiple sectors. But here's the problem with that strategy. Suppressing price doesn't solve the underlying issue. It doesn't create more supply. It doesn't reduce demand. It simply delays the adjustment. And while the price is being held down artificially, the physical market continues to tighten. Industrial buyers continue to consume silver. Nations continue to secure strategic stockpiles. Investors who understand what's happening continue to acquire physical metal. Every ounce that leaves the available supply is one less ounce that can be delivered when the paper market finally demands it. So the question business leaders must ask themselves is not whether silver will reprice. The question is when, and what that repricing will mean for their operations. For companies that rely on silver as an input, the strategic response is straightforward. Secure supply now, not through paper contracts, through physical delivery agreements with refineries and suppliers. Lock in long-term pricing where possible. Diversify suppliers to reduce dependency on any single source. And build inventory buffers that can absorb short-term supply disruptions. For investors and financial professionals, the implications are different but equally important. Understand that paper claims and physical ownership are not the same thing. In a crisis, paper may settle in cash. Physical metal is what holds value when trust erodes. This doesn't mean abandoning financial markets. It means recognizing their limitations. It means understanding that leverage works both ways. And it means preparing for scenarios where the assumptions that underpin those markets prove incorrect. But beyond individual preparation, there's a larger question that affects everyone. What happens to market credibility when intervention becomes the norm? Because once the public understands that prices are being managed rather than discovered, trust begins to erode. People stop believing that markets reflect reality. They start looking for alternative stores of value. They move away from financial assets and toward tangible goods. This shift is already happening, not just in silver, in real estate, farmland, commodities, and other hard assets. People are quietly diversifying away from systems they no longer trust. And when enough people make that shift, the financial system faces a different kind of crisis. Not a liquidity crisis, a confidence crisis. Confidence crises are harder to solve than liquidity crises. Central banks can print money to solve liquidity problems, but they can't print trust. This is why the silver story matters beyond the metal itself. It's a case study in how systems respond when reality conflicts with policy. And the response we're seeing, intervention, suppression, emergency directives, is the response of a system under stress. Governments and central banks have spent decades building an architecture of confidence. The belief that markets are fair, that prices reflect fundamentals, that institutions are stable, that the system works. But when that architecture is tested by physical constraints, by supply shortages, by demand that can't be met, cracks begin to show. And once people see the cracks, they can't unsee them. So what should the business community take away from this? 3 things. First, strategic resources are no longer governed solely by market forces. Governments will intervene when they believe national interests are at stake. This means that traditional supply and demand analysis must now include geopolitical risk assessment. Second, the gap between paper markets and physical reality is a risk factor that cannot be ignored. Whether in commodities, currencies, or other assets, the assumption that paper claims are as good as physical ownership is increasingly dangerous. Third, the next decade will be defined by resource competition, not just for energy, for the materials that enable technology, defense, and infrastructure. Nations that secure those materials will have leverage. Nations that don't will face constraints. Business leaders who understand this shift will position their companies accordingly. They will secure supply chains before disruptions occur. They will diversify away from single points of failure. They will build flexibility into their operations so they can adapt when market conditions change suddenly. And they will watch for the signals that indicate when managed markets are losing control. Those signals are already visible in silver, the backwardation, the rising lease rates, the delivery requests, the export restrictions from producing nations, the strategic stockpiling, the emergency directives. Now, these are not coincidences. They are symptoms of a system under pressure. And when systems are under pressure, they eventually release that pressure, sometimes in controlled ways, sometimes in explosive ways. The silver market is telling a story about resource scarcity, about market intervention, about the limits of control, and about what happens when physical reality can no longer be suppressed by paper promises. Whether that story ends in a managed adjustment or a disruptive repricing depends on decisions being made right now, behind closed doors, in government offices, in central banks, in the boardrooms of systemically important institutions. But one thing is certain. The pressure is building, the gap is widening, and time is running out. The question is no longer if the system will adjust. The question is how, and who will be prepared when it does.